Hey everyone, and welcome to this explainer on IAS 24. Today, we're diving right into the crucial and sometimes tricky rules of related party disclosures in corporate finance. If you've ever looked at a company's financial statements, you might think you're seeing the whole picture. But business isn't just about isolated numbers on a spreadsheet, it is heavily driven by relationships. So our goal today is to demystify how international accounting standards actually force those potentially hidden relationships right out of the shadows.
So here's the big question. How do investors really know if a company's deals are actually fair? It's a massive challenge. To get it, we really have to understand the concept of hidden influences. Because as the source material points out, related parties might enter into transactions that completely unrelated parties simply wouldn't touch. For example, imagine a parent company selling goods to a subsidiary right at cost. There is no way they do that for a normal, everyday customer, right? But even more fascinating, the mere existence of a relationship can change how a business operates, even if absolutely zero shady money changes hands. A subsidiary might stop doing business with a trading partner just because their parent company bought a competitor. The influence is there, whether there's a transaction or not.
To give you an idea of how seriously this is taken, let's briefly trace the history of IAS 24. Standard setters don't just write a rule and call it a day. They continuously adapt to protect investors. The original standard was adopted way back in 1984. Then, we saw a major revision in 2003 that specifically added disclosures on management compensation. Fast forward to 2009, and it was revised again to simplify definitions and untangle the complexities around government-related entities. It's basically a constantly evolving shield for financial transparency.
Okay, here's our game plan for today. We're going to cover the problem of hidden influence, how to actually define a related party, who gets excluded from that list, the disclosures you're required to make, and finally, those government entity exemptions.
Let's jump right into part 1, the problem of hidden influence and why these relationships absolutely matter. Paragraph 1 of the standard really hits the nail on the head here. The core objective is to draw attention to the mere possibility that financial positions have been affected. Now, the source text explicitly acknowledges that related party relationships are a totally normal feature of business. Companies use subsidiaries, joint ventures, and associates all the time. It's standard practice. But because there is control, joint control, or significant influence involved, these otherwise normal structures have the profound potential to distort a company's true financial health.
And this brings us to a really crucial concept: substance over form. Paragraph 10 of IAS 24 makes it a strict mandate. When evaluating a related party relationship, you have to look at the actual substance of the relationship, not just the legal form. You've got to look past the legal paperwork. If someone has the power to pull the strings behind the scenes, it really doesn't matter what their official title on the document is. The standard demands that the reality of that influence is recognized.
Moving right along to Section 2, defining a related party. Who is actually on the inside?
So what exactly is a related party? Well, it can be a person or an entire entity. Essentially, corporate groups operate a lot like family dynamics. Parents, subsidiaries, and fellow subsidiaries are all related to each other. Associates and joint ventures are brought right into the fold too. Why? Simply because they have the power to instruct or influence decisions. If one entity can dictate the operating policies of another or significantly influence them, boom, they are related parties under IAS 24.
And speaking of family dynamics, this concept extends way beyond just corporate entities. It literally includes actual family. The standard defines close members of the family as those who might influence or be influenced by a person dealing with the entity. As you can see, we're talking about children, a spouse or domestic partner, stepchildren, and dependents. So, if a key director's spouse is suddenly running a company that secures a massive vendor contract with the entity, well, IAS 24 ensures that relationship does not fly under the radar. Which leads us directly to Section 3. Who is excluded? Where exactly do we draw the line?
Just as important as knowing who's in is knowing who's out. The standard brilliantly illustrates this divide between insiders and outsiders. On one side, we have our insiders with actual control or significant influence. But on the other side are outsiders. The standard makes it very clear that certain groups are not related parties just because of their normal dealings. Providers of finance, trade unions, public utilities, and government departments that don't have control are generally excluded. Plus, and this is key, just because an entity does a massive volume of business with a single customer or supplier, creating a heavy economic dependence, that alone does not make them a related party. Economic dependence is simply not the same thing as structural control.
All right, Section 4, the required disclosures. Now that we know who they are,
What actually has to be revealed?
Let's look at the big picture first, parent and subsidiary disclosures. According to the standard, relationships between a parent and its subsidiaries have to be disclosed irrespective of whether there have been any transactions between them at all. An entity literally has to put a name to its parent and, if it's different, the ultimate controlling party. If those entities don't produce public consolidated financial statements, well, they even have to name the next most senior parent that does. This ensures users of financial statements always know exactly who is sitting at the very top of the corporate ladder.
Then there are the folks actually running the show. For key management personnel, their total compensation must be fully transparent. And you can't just slap a single vague lump sum on the report. Nope. IAS 24 requires compensation to be broken down into 5 specific categories: short-term benefits like wages and paid leave, post-employment benefits like pensions, other long-term benefits, termination benefits, and share-based payments. You get the whole shebang, a complete view of how the key decision-makers are being rewarded.
Now, what if actual transactions do happen between related parties? Paragraph 21 gives us a very specific list of transaction types that trigger detailed disclosure requirements. We're talking about purchases or sales of goods and property, rendering of services, leases, transfers of research and development, and the provision of guarantees or commitments. If any of these happen, the entity must spill the details: the nature of the relationship, the exact amount of the transactions, outstanding balances, and the terms and conditions, including if they are secured. You know, you hear corporate excuses all the time. Companies will often say, sure, we did a deal with our subsidiary, but it was completely fair, totally at arm's length. Well, IAS 24 has a super strict rule for this. Disclosures claiming that related party transactions were made on terms equivalent to arm's-length transactions can be made only if those terms can be substantiated. You literally cannot just vaguely claim the deal was at fair market value. If you put that in your disclosures, you better have the hard evidence to actually prove it. Finally, Section 5, Government Entity Exemptions. Let's look at the carve-outs. Back during that 2009 revision, standard setters realized that demanding granular transaction data between every single entity controlled by a national government would be an absolute bureaucratic nightmare. So they created a very logical carve-out broken down into 3 steps. Step 1. Identify if a government has control, joint control, or significant influence over the reporting entity. If the answer is yes, Step 2 allows them to apply a partial exemption. They don't have to disclose every single detailed transaction amount with that government or its other entities. But Step 3 ensures basic transparency isn't lost. They still absolutely must disclose the name of the government and the nature of their relationship.
But wait, even with that exemption, standard setters didn't give government entities a completely free pass. Entities still have to use their judgment to determine the level of detail to disclose, based on how significant those transactions actually are. They've got to weigh a few factors. Was the transaction massive in size? Was it carried out on non-market terms? Is it completely outside normal day-to-day business operations, like, say, buying a whole new business? If these factors apply, the entity still has to provide enough qualitative or quantitative info so users aren't left totally in the dark.
And that brings us to our final thought for today. Can a true arm's-length transaction ever be fully guaranteed when relationships are involved? IAS 24 obviously goes to great lengths to ensure transparency, meticulously defining insiders, mandating strict disclosures, and demanding absolute proof for fair market claims. But as we learned right at the beginning of this explainer, the mere existence of a relationship inherently changes behavior. It really shows how hard standard setters work to level the playing field, but it also leaves us pondering the absolute limits of financial reporting. Thank you so much for joining me today to uncover the hidden influences in corporate finance.